China for the better part of last 15 years was in the range of 2.5 from 2000. It barely was able to reach 3,000. Today, I think it's at about what, 4,500. And we are at 25, 26,000, even though we were at a very similar level after the crash. So in my view, the reason, so it's a country where the economy tends to do very well because the government can they have obviously a far, one can argue it's a more efficient way of running the economy. The government can mobilize things quicker than our governments can do. But does that necessarily make for very efficient capital markets? The answer is no, because if look at, pick up any industry. I mean, the everything they will, the kind of mobilization that they do. I mean, 3 years back, the Communist Party decided that their focus is going to be on EVs. Today, they are in 3 to 4 years' time, quite literally overnight, China becomes the world's largest EV maker, to an extent that they're like producing more EVs than rest of the world put together, right? There is no view of whether there is a demand, whether there is a market for these EVs or not. Just produce them at scale, and because every time you produce something that helps add to the GDP, that is not capitalism in my view. You're just creating overcapacity, you are distorting markets, and that's why you're producing goods which have no demand. And the result is that people rave about BYD and its technological progress, but BYD, is it an investable company? And the answer is no. I mean, if you overproduce, if you're producing in volumes where there is no demand for your goods at a viable price, how are you going to make a profit? And this is what is ultimately reflecting in the stock prices of all these iconic Chinese companies. And yes, there will be areas where I think the in recent times, I think the limited attraction for Chinese markets is that there is a one area where there is a genuine sort of undersupply kicking in is with respect to GPUs and memory sticks. And both of these are in very high demand because of data center deployments, and there is a very genuine sort of the Taiwanese and the Koreans are not being able to produce enough of it, and the Chinese have stepped in here, and they are I think a lot of FIIs are actually trying to chase that trade, and that chasing of that trade is happening at the cost of Indian markets. So that will play out for a while, but I'm firmly of the view that long term, India and China cannot compare. For all our flaws, we are demand driven. We are an economy where in we our economy functions under a structure where we can never have a private company being forced to overproduce to an extent where there is no demand for its goods. And doing, obviously, when you do that, there is a significant erosion of shareholder value. So those kind of things will never happen in India, and that's what makes and that's why India has always traded at so much premium compared to China. Not just China, I think most of the rest of emerging markets. So I am very bullish long term about India, especially vis-a-vis China. So let this rotation play out. I think it will take some time, but I don't think that we have to be overtly worried about that. Sorry, a very long-winding.
I wanted to tell to you and also to the team, actually, the conflict has not started in the Middle East. It is about to end because there is always the US wanted a regime change. Now, since all the top leaders have been eliminated, and US also stated now negotiation has become much easier. And the Trump administration in these aspects are quite result oriented, like how they cut and paste the Venezuelan top 2%. They are going to cut the war or end the war 1 week. So the market is coming closer to an uncertainty. Of course, the market will have an knee-jerk reaction, but it's going to recover faster. That is one. And one of the viewers asked about the how you are naming as bullish. Actually, there is the regime, the Fed governor is the new Fed governor is going to come during May. That is also a feel good and bullish aspect. Thirdly is the bank nifty weightage distribution deadline ends on March 30th, which SEBI introduced in 4 months before. So with all these considerations, I think the market is going to, because the certainty has come to the Middle East. Considering all these three factors which I said, I think market is going to remain bullish for the next 5 to 6 months. Then we'll see the recession after 4-5
I'm with you,
months.
sir. I'm with you. I'm with you. And I just hope everything that you said plays out. But I'm, as I said, I'm with you. I'm broadly at this stage. I think let this the next week and in general March will have a bit of an overhang till we get a decisive resolution of the Middle East conflict. But uh, at this stage, I don't see should be any reason to panic or take any money off the move money out of equities.
I have a question, Indraanil, for you regarding the IT
Sorry, can you
industry.
introduce yourself?
My name is Dhruv.
Okay,
I am from Hyderabad.
Sure.
I wanted to ask you a question regarding the IT bloodbath that we are having. What is your opinion on that? What is your view?
Yeah, I'm not honestly, I have said this many times. I'm not a sectoral expert or even a company specific expert. I think what the IT is going through its pain because of this belief that the advent of AI agents will cause very large scale disruption to the India services model. I don't know how well Indian companies are equipped to. I am personally of the view that uh, every technological leap of the sort of I look at AI as something which is an enabler. Obviously, there will be dislocation for people who are not able to adapt. But at the level of IT companies, will it be so bad that entire companies like TCS,
maybe a
Infosys,
year, Indraanil, they'll adapt.
Absolutely right. So they'll
They'll
figure out
adapt.
a
So
way.
it'll be a very
Yes,
nice entry
I
point
do. I agree.
into
I agree.
IT.
I agree. Will they be? Are they going to be such laggards that they will just not be able to adopt these new enablers
We've got the
and make
finest brains.
Correct. So it's very unlikely that but till they are able to sort of prove the markets wrong, I think there's going to be pain. So that's how how I look at it. But take my views with a pinch of salt. I am as such a more my specialty is to track liquidity, and based on liquidity, I take a view on how is it a good time to be in equities as an asset class or not. Within equities, what should be the subsector sectors where you should take your bets? That's not where I specialize.
Indraanil, can I ask a question? My name is Vikas. I'm speaking from Pune.
Your name, please. Sorry.
My name is Vikas.
Yes, Vikas, please.
So I wanted to ask that do you ever correlate India versus other economies? The reason I ask this is from last 1.5 years almost, India has been grossly underperforming all of them actually. I mean, many of the like South Korea, London Exchange, and even for the matter, Pakistan Exchange, so many of them, 14, 15 exchanges, they have performed to the tune of 60-70% on index level. Right. And US and India being the last two in those list of 15, 16. So number one is that. So secondly, have you tracked any correlation with Japan's liquidity? For example, I saw your all the videos on YouTube, and you mostly correlate between liquidity generated by Fed and that effect of that two different economies, right? But Japan is, on the other hand, sucking out the liquidity from last I mean, from some time, right? The interest rates are going up and they are sucking up liquidity via uh, quantitative tightening.
So let me address that. So important question. Happy that you asked that question. See, I focus more on US. I'm not going to deny that. I look at Japan to the extent that yes, Japan can be an adverse sort of a agent for global liquidity conditions if there's a large scale spike in Japanese government bonds, and that leads to uh, Japanese investors having to sell their assets in US and bring those assets back to Japan. If that were to happen, that will obviously be net liquidity negative for US, and that will almost certainly have an impact on India. So I think a lot of people tend to get carried away by the fact that Japanese long-term bond yields have started to go up, and that automatically means that people who have borrowed in Japanese yen and they have used that money to invest in US, people automatically assume that people will be forced to there will be unwind of that carry trade, and and that's negative for liquidity. Directionally, that may happen, but whether that's actually happening or not, I think the proof of that is in the USD yen exchange rate. Think about it this way: if bond yields are going up in Japan, and that as a result, if Japanese investors are forced to sell their assets in US and repatriated this money back to yen, back to Japan, that would mean that they will sell US dollar denominated assets, convert that money into Japanese yen, and bring that money back to Japan. If this is actually happening, then USD will go down, yen will start to go up, right? If that were to happen, that means that this carry trade is actually being unwound. But go back and have a look
Yeah,
at
it is going in reverse direction.
it's going in
Japanese
reverse direction.
yen is going up, right? I mean,
So
it is
so
depreciating.
my view is that I look at from a liquidity standpoint, the only thing that I keep track of is USD yen exchange rate. As long as that USD yen exchange rate is continues to go up, that means we are in a favorable condition. It's only when yen starts to appreciate meaningfully, that's when we know that there is some danger and we have to be cognizant about that. But unless that happens, and as of now, there is no sign of that happening. So I don't think that the whole Japanese carry trade unwind being such a big factor. It might become a factor at some stage. It's that day is not today.
And one more follow-up question regarding US liquidity. So in December, they started some sort of QE, but they are issuing treasury notes, not treasury bonds, which are short term. So and we don't know the quantum actually. Do you know by any chance from where we can track how much of the liquidity is being infused into the system and for how long? Because notes are very small for very small time.
So search every Wednesday. So you saw this. So this is Fed balance sheet versus Nifty. The red line, which is the Fed's balance sheet size, this represents how much this represents how much bond the Fed is buying. This is this represents two things. This is the amount of new dollars that the Fed has printed. This also represents the amount of US government bonds that the Fed has bought, because these new dollars are basically the way these new dollars are flow into the economy is by way of the Fed buying US government bonds using these newly printed dollars. So the US government issues new bonds, they are bought by the Fed with these newly printed dollars. the money goes to the US government, and then US government spends it on its various spending items, and that's how this money goes into the real economy. So if you track this red line, that's how you know how much money the Fed is printing. This line can be tracked on Fed's website. Go to this website called FRED. So search for FRED space Fed balance sheet. The first search result that you get, that's where you will find this red line. If this red line is going up, every Wednesday the number is published. So compared to last Wednesday, if this Wednesday the number has gone up, that means by that much, the difference between last Wednesday and this Wednesday, that's the amount of new dollars that got printed between last week and this week. That's how you calculate. Right now, the approximate number is $40 billion per month. That's the rate at which short-term bonds are being bought by the Fed.
Okay.
Hi, Indraanil. This is Sunil here from Thane. Yeah.
Sure.
So Indraanil, now my question is regarding the IT industry of India that we, even I'm some sort of an investor. Now, the whole AI thing, the AI summit that I could see that happened in Delhi last few weeks or so, in the whole take up from that, what I see is that India doesn't have any AI stack, which it is building on or has a plan to build on. With the US advisor to the Trump was an Indian fellow who came down to India during this summit itself and told that you should be using US based or the Western based AI stacks on which people from IITs and other premier institutes will be building things which will be like superimposing various languages on those stacks and taking some health kind of applications. But the whole thing that I take is that they were here, the whole lot from Sundar Pichai to everyone else was here to sell their form of AI. Now you've been in the investing business for quite a long time. Have you, and also given the Indian IT industry with so big Indian IT industry, now do you see or talking to any of the IT fellows, IT top management, do they have any intent to make any AI stack, or are they going anywhere close to what China has already done or the West has already done? Yeah.
Completely above my pay grade, Sunil. As I said, I track liquidity. I can give you my views on this, but I don't have any sort of special insights on how Indian IT companies or specialized startups in the AI space, how are they trying to sort of build a India stack when it comes to with respect to their AI approach. Honestly, my view, as I said, is that over the medium terms, our companies and startups will figure out a way to use these LLM, large language models to improve their productivity. The headcount might go down, but at a company level, I think we will figure out a way to be a lot more efficient than we are. Our IT companies are today. What are the specific initiatives that our companies are they going to ride on large language models developed in the West, or are we going to build our own models? Honestly, I'm not a sectoral expert on that, but long term, I think that this pain will ease out. We will figure out a way to use AI in a way where our companies can basically build a viable business model.
Okay, it's just the use of AI, right? We'll be at a consumer level, not a creator level also, right? That's what your take is, correct?
Probably, yeah.
Thanks, Indraanil.
Thanks.
Indraanil,
Yeah, I have a simple question. This is Rajesh from Bangalore. You showed the MOVE index versus Nifty, and whenever the new MOVE index is shooting, then Nifty is at the bottom.
Hmm.
And you said you will be more defensive when it shoots up.
Hmm.
Then you are very defensive when the Nifty is at the lowest point, or
Hmm.
how much the Nifty lags from the move index.
Yeah. So anytime the move index is so I don't react to the move index on a daily basis. As I said, I look at the absolute levels. Move index start shooting up is to a level of above 100 is where I become very cautious. If it goes above 120, then I definitely move to a lower sort of a equity posture for till the move index comes down below 100. That's the way I look at it. But on a daily basis, it's not as if that it goes from 70 to 90. I will cut down the equity exposure. I don't, on a daily basis, it's not as if that I keep adjusting my equity posture based on move index. I look at the absolute level. If the spike takes the move index above 100, that's when I start to take action.
Yeah, thank you.
Yeah, hi, Indraanil. This is Neeraj Khare, calling from Navi Mumbai.
Yeah.
Yeah. And I just want to know why gold prices are going up and equity is still not performed well. What is the reason?
So I won't say so. Equities have been flat; they have underperformed. Gold, I think, has. So I'll do I think the answer can become very long. I think what is I'll probably do a dedicated video on gold. I've got many requests for that, but I think broadly what is happening, sir, is the way I look at gold is if you look at, let's say, from 2000. I think broadly what is happening with gold is gold in itself is an asset which doesn't produce any dividend or it's so the way it's loses its gains value is when any other asset loses value compared to gold. So what I mean by that is that over the last 10-15 years, one phenomena that has gained a lot of strength, especially in the large Western economies, especially in US, in Europe, in Japan, is government deficits have completely gone through the roof. I think US fed money based on your credit worthiness to cover for this deficit. That is what I called market link mechanism. But largely in most of the Western economies, what is happening is that the way they are funding their deficit is basically to go back to their respective central banks and asking the central bank to just create new money out of thin air, print new money, and lend the money to the US government. So US government is basically not coming to you and me and borrowing money from investors. They are just going to the Fed, asking the Fed to print new money to give and give that new money to the Fed, to the US government to fund the deficit. Now, when you fund your deficit by asking your central bank to just print new money, create new money out of thin air, in a way, you are just debasing your currency. Right? If anybody else were to do that, that would be called counterfeiting. That would be illegal. But that's exactly what the Fed and the US government and pretty much every Western government has been doing for the last 15 years. Now, when you debase your currency, the value of your currency goes down. Right? And if your value of your currency goes down, then something else which cannot be printed like US dollars, the value of that will go up. So gold is something that the Fed cannot print. And this correlation is so tight. Sorry, can I request everyone to go on mute? There's a lot of background noise. So since 2008, I have done this exercise. 7 trillion deficit has gone up to 37 trillion. If you do a CAGR of this, that translates to an annualized rate of about 8%, 7.9 to be precise. If you look at gold's appreciation since 2008, exactly 7.9%. So basically my view is as long as Western governments continue to live beyond their means, if as long as their deficit continues to go up, and US deficits are going up at about 8% annually, and they continue to fund this deficit through money printing, gold,
layers येतात ना तसे नाही आहेत.
so gold will continue to have. So in my view, gold's USD returns are gold. It's a no-brainer that. Sorry, there's somebody who is. There's a lot of background noise. Can I ask whoever is talking to go on mute, please? So if this phenomena continues to play out, which I think it will, gold in USD terms will easily continue to go up at a rate of at least 8 to 9%. USD 8 to 9% means about, you can add 4% more in when you look at gold's appreciation in INR. So in USD terms, gold I think can continue to go up at 8% for the foreseeable future, which means in INR terms, it's a no-brainer that gold will continue to go up at least 12% going forward. I'll do a dedicated video on this, but that's broadly how I look at gold.
Yeah. Follow-up question is that
I'll take 2 more questions, and then I have one. I want to just talk a little bit about the AlphaSIP strategy. So I want to save some time for that. Yeah.
Yeah, Indraanil, one small question. So
can you introduce yourself, please?
Yeah, my name is again Vikas. This is a follow-up question. So many of the central banks are dumping the US Treasury bonds because of the fiscal factors only. So is that not sucking out the liquidity from whatever extra money Fed is printing, and thereby that money not coming into equities?
So that would have been liquidity negative had Fed not been buying those bonds. So if the US government is selling bonds at a time when there's nobody, when Fed is not there to buy those bonds, then the private sector has to buy those bonds. So that's liquidity negative. But if the Fed is there and buying up all the bonds that the government is selling, then whatever liquidity is available with the private sector investors is freed up, and that can then be deployed into stocks and bonds of private companies. So at this stage, we are in a very liquidity positive situation in my view. That's why, because whatever bonds the US government is selling, though the Fed is buying up all of that. I'll take one more question for somebody who hasn't asked a question, not somebody who has already asked. Somebody who hasn't asked any questions so far. Anybody?
Yeah, Indraanil, this is Rajendra here from Mumbai.
Yes, Rajendra. Yeah.
So my question here is, all of the checkpoints that you have been mentioning in your videos and data points also are all with the perspective of the US markets. We all know that since 2022, FIIs have been net sellers in the Indian markets, month on month as well as on a monthly basis, actually. So your thesis suggests that the move post 2022 has been because of on account of liquidity which has come in from the US. So whether the DII data is not to be taken into account in your model, or do you take the DII data as well in this model of yours? Thank you.
The way I look at this is the DII money is anyway available for us to create, is there for us. That is creating a demand for Indian equities. Beyond that, on the margins, if FIIs are net sellers or net buyers, that creates marginal demand, or that creates marginal supply. So that to that extent, I keep track of I don't per se track FII versus DII absolute dollar amount. I instead try to look at the proxies such as move index, junk bond spreads, how Fed's balance sheet size, because Fed balance sheet size, for example, it's a very good proxy of if the Fed balance sheet size is going up, that in general would mean that FIIs are now usually you'll have more money at hand to bring money from US to India, and that should over time start to help improve liquidity conditions in India. So that's the way I look at this. So in my view, the domestic flows are there anyway. When domestic flows go up, that can only be invested in Indian equities. That money cannot go out. On top of that, if what I try to look at is, are FIIs adding to that demand, or are they sort of taking out from that demand? So that's the way I try to view the FII action.
Yeah, just wanted. Still, 85% of the FII money is still within India only.
Yeah. So
It's only
bulk
a
of that.
marginal amount they are selling.
Correct.
But in absolute growth, it's really big. Yeah.
Correct. Yeah. I agree. Anyone who hasn't asked a question so far and has a question?
Hi, Indraanil. This is Ajay here.
Yes, Ajay.
Indraanil, I have been invested with you via FinFech, and that's been 2017, 2018.
Okay.
So I have had some experience of working in your strategy.
Sure.
I had a question to you with regards to the funds. Now, instead of, so I know you're going to be talking about your strategy. I just wanted to know, would you think or would you be trying exchange traded funds? Would that be a better option for to invest? Would you consider that, or in India as well as probably even the US? Because right now a lot of people have started thinking about investing in internationals also, and right now they do not have anything that works in that, or they don't have any experience, including me. So I'm not sure whether this is the right forum to ask that question, but I thought, because on a base of strategy that you're going to be talking, would you consider that?
So if I may, Ajay, let me just cover that because I have a dedicated section on AlphaSIP. I will be covering which are the instruments which work best with the AlphaSIP strategy. So if you don't mind, just bear with me. I'll address that in that. And if it's still unanswered, I'll take it up in the Q&A after my AlphaSIP presentation.
Sure.
Okay, can I then quickly move on to my AlphaSIP presentation?
I have one question. Could you please?
Okay,
1 minute only. I'll take.
Yeah.
Yeah. This is Safiq Alam from Kolkata, and the question is, when Nifty topped in September 2024, IT sector also topped. We topped, keeping in mind that recession is coming soon in US, and most probably that is going to hit across all the geographies. So suppose we are not going to meet recession anytime soon, maybe 1 year or 6 months. I mean, anyhow, if we somehow avoid recession, so can we say that IT can rebound, or is I really doubt that it is because of AI only IT is being hampered or being, I don't know. I mean, they are actually destroyed because of that. It is not that AI is new and we are covering or realizing that they are actually in this month only, because AI is there around a year. This is not a new thing for which IT is being punished now. So again, I mean, the question is it IT is not rebounding, or IT is falling, or IT is trying to find out bottom in the is because, I mean, US recession because of that.
So I see again a lot of you guys continue to have a very outsized view about me to have insights about IT, which I honestly don't. But my limited view again is basis what I've seen play out in the past. My near-term view is that I think there is more pain to play out for the IT sector because, as I said, this whole AI-based narrative that has been created, that's not positive for the industry. How does a US recession impact Indian IT? I think in the immediate, as I said, in my base case is that in the sometime in the second half of 2026 is when I believe the US should slip into a recession. Once a recession kicks in, I think in the immediate aftermath, everything gets hammered and IT will get hammered as well, because there is a complete demand, there's outright demand destruction in the US. So that will impact American companies, and that's usually always very negative for IT as well. But I think what has historically also happened is IT is amongst the first to start rebounding, because once the post-recession sort of recovery kicks in, the usual playbook for most companies is to look for services and ideas which can be outsourced to India. So companies usually in that recovery phase go on an overdrive to outsource, and that usually is very positive for the IT sector. So while I think if I don't know whether the ongoing pain for IT will continue to linger on till the second half of 2026, which is when I expect the US to slip into a recession or not. But broadly, my view is that once a recession kicks in, everything gets hammered, including IT. But post the initial shock, once the recovery kicks in, once the rebound kicks in, I think IT will be amongst the first to recover, because there will be a lot of latent demand and additional items that companies will look to outsource. So that's broadly how I look at it. Okay. Can I start with the remainder of my presentation? So
yes, sir. Please continue. Please continue.
Good. So the reason so AlphaSIP is not something new. We have been, pitching this to our clients for almost 2 years now. But there are, as I mentioned this in my sort of introduction video yesterday also, that we have made some very notable changes in AlphaSIP, and these changes are very specifically with respect to the kind of funds and ETFs that we use as part of the question that Ajay you asked. The changes that we have actually introduced now is actually with respect to the instruments that we use in case of AlphaSIP, which is what has which is what makes AlphaSIP as an offering fundamentally different from what AlphaSIP used to be so far. So I'll cover that. So for the benefit of everyone, I'll just give a very quick introduction to what is the problem that we are trying to solve through the AlphaSIP strategy. So the fundamental problem that we are trying to solve with AlphaSIP is that when you do a SIP, most people believe that you do a FD, you get 7 to 8% return. If you do a SIP in a disciplined manner for a period of 4 to 5 years, that's the most reliable way of getting a low to beat FDs and get a low double-digit return of 10 to 12%, right? This is what, at the onset, let me tell you, that's a very, very misplaced assumption. And so firstly, I want to show to you why I say that that's a misplaced assumption. And secondly, how through AlphaSIP we are able to solve this problem. So the chart that you see is basically the historical performance of a 5-year SIP in the Nifty. Historically, if you do a SIP, so what I've done, I've gone all the way back to January 2010. For every month, I have assumed that if you did a SIP in the Nifty for the next 5 years, what is the return that you got? So so let's say if you did a SIP between January 2010 and January 2015, you would have got 14.5%. February February 2010 to February 2015, 16.6%. Like this, if you you come to the most recent 5-year period, January to, I did this in January. Now we are in March, so we have 2 more data points available. I prepared this chart in January. So January 2021 to January 2026, your return, 5-year SIP return would have been 12%, 12.04%. So there are, as you can see, there have been 133 months since January 2010. And in any of these 133 months, if you did a 5-year SIP in the Nifty over the next 5 years, what is the return that I have calculated? For every month, then if you did a 5-year SIP, what is the return? That is what is there in this chart. If you do, what's the point of doing this huge exercise? Only if you do this exercise will you be able to find out what's been the best case, worst case, and median case return of a 5-year SIP in the Nifty. So turns out the best case return of a 5-year SIP in the Nifty has been 20.35%. You would have got this return had you done a 5-year SIP between October 19 to October 2024. Worst case return, you would have got between April 15 to April 20. Median is 12.5%. Limited point, what is coming out from this chart is that why is April 15 to April 20 so bad? Negative 5.82%. Because you did a 5-year SIP. At the end of 5-year SIP, we got the COVID pandemic when the markets crashed by almost 40%. A 40% crash basically wipes out the return of previous 5 years and your return became negative. Why was October 15 to October 24 so good? 20%. That is because the Nifty peaked in September of 2024. So if you do a 5-year SIP, at the end of 5-year SIP, the Nifty is at a new all-time high. Your 5-year SIP returns will be like 20%, right? So this is the problem that we are now. Because of this, the problem that you are faced with is that, let's say you have a life goal. You have a child at home who is in class 7. In 5 years, he or she will finish class 12th, go to college. Your financial goal is you want to build a corpus of, let's say, 20 lakhs to pay for the engineering or medical college fees of your child in 5 years. Now, to get to 20 lakhs in 5 years, you will go to your financial planner. He will tell you that assume a return of 11 to 12% and he will calculate for you what is the SIP amount that you need to invest every month for the next 5 years to get to 20 lakhs. But the problem here is that you have assumed a return of 11 to 12%. Whereas what this chart tells us is that historically the Nifty's 5-year SIP return can be anywhere between negative 5.82 to positive 20.35, right? There is no guarantee that this 11-12% that you have assumed is not something that the Nifty is bound to deliver. In fact, where it becomes even more scary is that out of 133 months, just imagine how many months the Nifty's 5-year SIP return was 12% or more than 12%. It was only 73 months. 73 out of 133 translates to a probability of only 55%. So only on 55% of the months, your return was 12% or more than 12%. Reason I call 55 only 55 is because when you toss a coin, the probability that you get the coin toss right, that probability is 50%. So your probability of getting a return of 12% or more than 12% at the end of a 5-year SIP in the Nifty is about the same as the probability of getting a coin toss right. So my limited point is something with a historical probability as bad as a coin toss probability is not something on which you can leave a crucial life goal like building a corpus for your child's college education. You are assuming that your 5-year SIP over the next 5 years will get you 12% or more than 12%, whereas the historical probability of getting that is only about 50%. So that's not a good probability. What we try to, and this is the problem that we are trying to solve. With AlphaSIP, we never tell you that come to us, we will help you generate 20%, 25%, 30% return. What we try to do is to help you achieve 12% return, but with a 90-95% probability. So we are not here to help you get high returns. We are here to help you get reasonable returns, but with a very, very high probability. That's what AlphaSIP helps you do. Now, how is it that we help improve the probability of 12% return? So for that, I'll go back to something that I alluded to earlier in my video. Let's say I'll give you one example of how we introduce an element of market timing to improve the probability of 12% return. So one of the parameters that we use to introduce an element of market timing is something called high yield spreads. I have, as I mentioned, I have already explained high yield spreads in this earlier video of mine, which I had published on 12th of April 2025. Please do go and have a look at this video. I'm going to leave a link to this video in the description. But the limited point about high yield spread that you should keep in mind is that this is how high yield spreads have trended since 2007. And the blue line is the Nifty. The Nifty and high yield spreads have historically had a very strong inverse correlation. Whenever the red line, the high yield spread goes up, Nifty usually starts to go down, and vice versa. Whenever the high yield spreads go down, Nifty usually witnesses very strong rallies, right? Now, another important thing about high yield spreads is so based on high yield, so now based on this, what we have to do is that whenever this red line, high yield spread, goes up, those are times when the Nifty experiences large drawdowns. So whenever this red line is going up at a very fast pace, those are times when we have to get out of Nifty. Those are times our portfolio should not have a lot of equities, right? So let's define a rule which can be through which we can execute this. So I have zoomed in here. This is the same red line. This is how the red line has looked like since May of 2024. So this is what I'm proposing that you should do. Every month on the first trading day, look at where this red line is, right? Then, and when I say on the first trading day, look at where the red line is, I am talking about not the value of the red line on that day. I am talking of the average of the previous 30 trading days. So on the first trading day of April, of any month, calculate what is the average of the previous 30 days as of the first trading day. Then go back 1 month. Previous month's first trading day, what was the value of the red line? Again, when I say what was the value of the red line on the first trading day of last month, I mean average of the previous 30 days as of the first trading day of last month. Now, based on this, you'll be able to find out that this red line has gone up or gone down by how much over the last 1 month. If this now this is the important part. Please hear me very. Please pay attention here. If the red line, if in the current, as of current first trading day of the current month, if the red line is more, the two conditions have to be satisfied. If the current value of the red line is more than 3.5% and the red line has gone up by 5% or more than 5% over the last 1 month, that means that for me, that is the condition for which indicates that this red line is witnessing a very sharp spike. If these two conditions are fulfilled, for that month, I will get out of equities. I'll move my entire portfolio to a liquid fund. If these two conditions are not fulfilled, I will continue to remain fully invested in equities. So I'll just repeat that. Every month on the first trading day, I will look at what is the red line at. If the current value of red line is not 3.5, I meant 3.75. If it is 3.75 or more than 3.75 and this red line has gone up by 5% or more than 5% over the last 1 month, then that means the red line is going up at a very fast pace and I want to get out of equities. I will move the entire portfolio to a liquid fund. That means my equity exposure of my portfolio will become zero. If not, I will continue to be 100% invested in my portfolio. When I say I'll move the entire portfolio to liquid fund, I'm not talking of only that month's investment. I'm talking of the entire portfolio. If I've been doing SIP for last 1 year, then whatever money I have accumulated over the last 1 year, the entire money I'll move to a liquid fund if the two conditions are fulfilled. If the two conditions are not fulfilled, then I will continue as it is. I'll continue to remain fully invested in stocks. So every month on the first trading day, I have to do this rebalancing between liquid fund and Nifty. I will do that for 5 years. For 60 months, I'll do this rebalancing. If I do this, what is the outcome? This is the outcome of a 5-year conventional SIP, I told you. Negative, worst case, negative 5.82, best case, 20%. When you introduce the rebalancing logic based on junk bond spread, now look at the worst case return. Worst case return improves from negative 5.82% to positive 8.26%. Median also improves from 12.5 to 14.39%. Right? So that's a very significant improvement. Your median also improves, but the most important improvement is in the worst case. So very high downside protection. You get to keep the upside, but even in the worst case, your returns are better than what a bank FD can potentially produce for you, right? So this is when you rebalance between Nifty and a liquid fund. Can we do better than? So this is the first improvement. Second improvement is that in case of a conventional SIP, we just saw that out of 133, only in 73 months, the returns were more than 12%, which is 55% of the month. When you introduce this rebalancing based on junk bond spread, that 73 goes up to 103. So 103 out of 133. So now the probability has gone up from 55% to 77%. So that's a very significant improvement in probability of 12% return, right? Can we do better than this, right? So for this, now I come to Ajay, this is specifically for you. Which is the fund? So far I was talking about, on equity side, I was using Nifty. On the debt side, I was using a liquid fund. I was using HDFC liquid fund on the debt side. Instead of Nifty, if we use this, there is another index called Nifty 500 Multicap Momentum Quality 50 Index. Momentum, so basically this is an index which has been around since 2005. For last almost 21 years, this index has been around. This index is executed as per what is called a momentum strategy. A momentum strategy basically means that when you talk of Nifty 500 Momentum 50 Index, what this basically means is that every 6 months, people who have constructed this index, they basically look at which were the stock out of the top 500 stocks in Nifty, which were the top 50 stocks which went up at the fastest pace. So that is in the last 6 months. So those 50 stocks become part of this index for the next 6 months. Again, at the end of after 6 months, again this exercise will be this index will be rebalanced. The people who manage this index, they will again take a view in Nifty 500, which are the top 50 stocks which went up at the fastest pace over the last 6 months. So again the top 50 will be replaced accordingly. So every 6 months this index is rebalanced based on this logic. Now when you do this, the outcome that you get compared to Nifty is mind-boggling. So I want to give you an idea. This index has been around since April of 2005. So over the last 21 years, the Nifty's return, if you had in April 2005, had you invested 1 lakh rupees in the Nifty, that money would have in January 2026 would have become 12.6 lakhs. So in last 21 years, 12.6 times, right? Same 1 lakh, In the Nifty 500 multi-cap momentum quality 50 index, 1 lakh would have become 41 lakhs. That's nearly 3.5 times outperformance compared to the Nifty. So that's the kind of improvement that you get when you choose a momentum index instead of the Nifty index. Now, this is where the biggest improvement in AlphaSIP 2.0 becomes. See, this index has been around since 2005. But for us to be able to use this index, some fund management company will have to replicate that index and offer it to investors in the form of a fund or in the form of a ETF. And what has happened, and that is what has happened over the last 6 to 12 months. We have a bunch of companies who have now started offering this in the form of a fund or ETF. These momentum indices are now available to us in the form of a fund or ETF. And that's how we have now been able to include this as part of the AlphaSIP strategy. I will tell you, when you use the AlphaSIP, when you use this momentum fund, on the equity side, so far you were using Nifty, and debt side we were using HDFC liquid fund. Instead of Nifty, now if you use this momentum Nifty index, this is the outcome that you get for a 5-year SIP. Look at the worst case improves little bit from 8.26, it goes up to 9.09. But just look at the median case improvement. It improves from 14.39, almost a 10% jump, 14 to 24. That's the improvement in median case. So that's how that's how dramatically your median case can improve when you start using these momentum indices instead of a normal large cap index, right? And now it's possible for us to use them as part of the AlphaSIP strategy because we now have funds in the AlphaSIP in the basket offered by various companies that we can use as part of the AlphaSIP strategy. Now, this what is the impact? What is the improvement in probability of 12% return? Now, out of 133, 127 months, the returns are 12% or more than 12%. So your probability of 12% return is now 95%, right? Very, very high probability. And this is, mind you, I have given you the fund, I have given you the logic. Up to this point, there is, you don't even, if you are willing to do this rebalancing on the first trading day of every month, you can execute this strategy yourself. You don't even need my help, right? And you will be able to, and the outcome that you can get is this: median case return 24, worst case 9.09. I'm not saying that historical performance necessarily gets repeated, but for whatever it's worth, these are phenomenal results, and you can do it yourself without any help from me or any other advisor. This is the outcome that you get by introducing an element of market timing based on one parameter, junk bond high yield spreads or junk bond spreads. They mean the same. In AlphaSIP, we use more than 15 market parameters to do this rebalancing for you. And when you introduce these 15 market parameters, when you are using just one parameter, junk bond spread, your worst case was 9%, median was 24%. You introduce all these 15 parameters, look at the worst case and median. Worst case was 9%, that has gone up to, I'm talking of the worst case return, 24%. Median case goes up from 24 to 31%. So on the equity side, I am using the momentum index. On the debt side, I am using a liquid fund. So this is what you get when you use all the 15 parameters. Now I have to repeat with everything with every grain of my existence. I'm not trying to suggest that this is historical performance. I'm not trying to suggest that this is something that we are sure to get in future as well. So take it with a pinch of salt. There is no guarantee that historical performance will be repeated in the next 5 years as well. But I have done an honest job of backtesting and checking the performance of this, not just during the good times, but also during crashes like of the sort that we saw during COVID, where the market fell by 30-40%, even during such times, this strategy has held good. And even during including the COVID period, the worst case has so far been 24%. So for whatever the worst case historical performance is worth, I think this is what the historical performance looks like. What is the probability of 12% return? Well, if the worst case is 12%, 24%, the probability of 12% is obviously 100%, right? So this is the historical performance. Last part, and this is the most controversial part, how do we execute the AlphaSIP strategy? Well, we execute the AlphaSIP strategy using something called ULIPs, right? A lot of you don't like us because we tend to use something called these ULIPs, because the perception is that ULIPs are very high cost, charges are very high. And I'm not taking away from the fact that historically ULIPs have been very expensive. So your apprehensions are not misplaced. But let me just put it this way, that the reason we use ULIPs is, so the reason we use ULIPs to execute this strategy is because ULIPs have this unique advantage that if you use ETFs or mutual funds or even direct stocks to do this rebalancing every month, then every month you will end up accruing capital gains tax. And since we rebalance every month, these capital gains will be, most of these capital gains will be short term. So you will end up paying tax based with short term capital gains rates. In case of ULIP, they enjoy this unique tax advantage. There's a lock-in of 5 years. That means you cannot stop your SIP or you cannot withdraw your money for the first 5 years. But in lieu of that, the government gives you this unique tax advantage that any rebalancing, any switching that you do between funds during this lock-in period of 5 years, that does not lead to any short-term or long-term capital gains tax. That is first tax advantage. Second tax advantage is that even after 5 years, if you withdraw your money, if your investment amount was within 2.5 lakh rupees per year, 2.5 lakh rupees per year works out to about 21,000 rupees per month. As long as your SIP amount was within 2.5 lakh rupees per year, the entire maturity amount is tax free. Which is why I say that this is a tax advantage which is not there in case of direct equities, which is not there in case of mutual funds. Especially in the new tax regime, there is no other investment option where this tax advantage exists. And that's why I tell everybody that your first 20,000 SIP must go into ULIP. You should exhaust your tax-free allowance of which the government gives you before you explore SIPs in mutual funds, right? Now coming to the question of why should you invest in ULIP despite these charges that ULIP companies impose on us. Now the reason we choose, so you have to understand what is it that why is it that ULIPs have historically not created very good returns for most investors? The reason for that is that ULIPs impose something called allocation charge on, there's a cost called allocation charge, which is charged by ULIP company. Allocation charge is nothing but a form of entry load. Mutual funds used to also charge entry load almost 10-15 years back. SEBI has banned entry load now, and mutual fund companies are not allowed to impose entry load. So back in the day when entry load used to be there, the entry load used to be 1 to 2%. So if you invest 100 rupees, only 98 gets invested. 2 rupees gets deducted and is charged by the company, is kept by the company. Now SEBI has banned that in case of mutual funds. In case of ULIPs, this entry load continues to be charged by ULIP companies, and the quantum of entry load is not 2%, it is as high as 6 to 10%. And that's why, you invest 100 rupees, 6 rupees gets deducted, only 94 rupees gets invested. That if 6 rupees gets deducted, then your final return can never be good. Even in a good year, if the market has delivered 15% and 6% has been deducted towards entry load, your return will only be 8 to 9%. In a bad year, if the market itself has delivered 5% return and 6% has been deducted towards entry load, your return will be negative 1%. And that's why, because of this very high entry load, ULIP returns have historically never been very good, right? And that's the reason historically, until recently, we never sold ULIPs. We started selling ULIPs because after people like us who kept prodding these ULIP companies to come up with a product where in case of ULIP, the entry load is not called entry load, it's called allocation charge. So we kept pushing these ULIP companies that you should come up with a product where there is no entry load, no allocation charge, just like in case of mutual funds. And finally, in 2023, few of these companies, HDFC was the notable first, followed by Bajaj Allianz. These two companies came up with a ULIP product where there is no allocation charge. Whatever you invest, the entire amount gets invested. There is no entry load in this ULIP. This is something that they came up with. These ULIPs are called zero allocation charge ULIPs. Now the problem with this ULIP is these companies themselves do not promote these ULIPs very aggressively. So most of the insurance agents will not even tell you about these zero allocation charge ULIPs. So the problem about these ULIPs is you'll have a very hard time finding an agent who will sell you this ULIP. We are amongst the very few agents who sell these we sell only zero allocation charge ULIPs, right? To give you now, I want to be very clear. What are the charges? Having said that, these zero allocation charge ULIPs are the cost structure is significantly lower compared to a conventional ULIP, where the charges are much higher. But still, there are a few charges, and I want to spell out those charges for those who might be interested in investing in that. In these zero allocation charge ULIP, there are three sets of charges. Allocation charge, which I said is zero in case of the zero allocation ULIP. Some of these ULIPs, instead of allocation charge, have introduced something called admin charges, and I'll come. So the Bajaj Allianz ULIPs. So we sell two ULIPs, Bajaj Allianz and HDFC. HDFC, there is no allocation charges, there is no admin charges. It's zero. In case of Bajaj Allianz, allocation charges are zero, but they charge an admin charge of 500 rupees per month, which 500 rupees per month means 6,000 rupees per year. And this is a ULIP with a 5-year lock-in. So in 5 years, 6,000 into 5, 30,000 is what they will charge you in admin charges over a period of 5 years. So in HDFC, there is no allocation charge, no admin charges. In Bajaj Allianz, there is no allocation, but there is an admin charge of 30,000 rupees, which will be charged to you over a period of 5 years, 500 rupees per month. Second is, and I will tell you what is the impact of this on your final return. Then there is mortality charge. Mortality charge is basically when you invest in a ULIP, you also get some amount of insurance. If you are investing 2.5 lakh rupees per year, then you get an insurance cover of 10 times of the annual investment amount. So if you're investing 2.5 lakh rupees per year, you get 10 times of that. 25 lakh rupees ka you get insurance. Now against this insurance, to pay for this insurance, some amount of money will be deducted to pay for the premium of this insurance cover. So the amount that gets deducted to pay for the insurance is called mortality charge. And finally, third is the fund management charge, which is there in case of mutual funds also. Now, what is the impact of all these three charges on your final return? Let me explain that to you. This is the impact on final return. See, the return, the charges keeps on increasing with age. The reason for that is that the 25 lakh rupee insurance that you get, the cost of insurance of that 25 lakh rupee insurance keeps on increasing with the age.
You're not sharing. Can you share the screen, please?
Oh, it's not coming. Is my screen visible now?
Yeah, it is now. Perfect.
So this is the impact. I'll tell you how to Were you guys able to see my the all the return numbers that I was showing so far?
Yes, sir.
Yeah, it was showing earlier.
Okay. Let me put it this way. See, I'll explain this chart to you. This is the impact of the charges. So these are the charges in case of a Bajaj Allianz ULIP, where this is the so let me show let me explain how to interpret this. Let's say if you're 40 years old, in case of a 40-year-old person, the impact of charges is 1.21%. Okay. What this means is that on the right hand side, I showed you earlier that in case of the AlphaSIP strategy, the historical performance with a Nifty momentum index fund is worst case 24%, best case 45%. So the range of return is anywhere between 24 to 45. Let's assume that we got at the end of our 5-year SIP, we got the worst case return of 24.13%. What this means, this 24.13 is before charges. After charges will be, if you're 40 years old, then the charges are 1.21%. So you deduct 1.21% from 24.13, which will, so it will come to about whatever 22.9%, right? So whatever is the return that you have got, you deduct the charge mentioned against your age. If you're 35 years old, then the impact of insurance is only 1%. So then you deduct only 1.07 from 24.13. So whatever return you have got, from that you have to deduct this amount. Now, the other thing that you might see is that the cost of insurance keeps on increasing. Now, this percentage includes both the cost of insurance plus that policy admin fee of 500 rupees per month. Both are taken care in this. So I am talking about worst case return 24%. After charges, 24% becomes 22.9%. So even after charges, this is after taking all the charges that you have got in case of Bajaj Allianz, you still end up with worst case return more than 20%. And that's why I say that, it's worth investing in, ULIPs, the zero allocation charge ULIPs, even after accounting for this policy admin charge of 500 rupees per month, makes for a very, very compelling proposition because they allow us to do this rebalancing without any tax implication at a cost which is very, very nominal. And I believe that, the proposition becomes even more compelling in ULIP because of the insurance factor. Because in insurance, as you can see, just for you take a return, your hit to return is about 1%, 1 to 1.2%. Just for about 1% hit to return, your final goal amount is fully insured. God forbid if something happens to you during the investment period, your beneficiaries, your dependents are fully covered. So for a very small hit to your returns, I believe that this is something that everybody should opt for, right? So this is how this is what AlphaSIP is about. So I won't stretch it anymore. This is what I wanted to present. I'll be happy to take questions if anybody wants to ask any question on this.
Yes, sir. Actually, I've seen you were showing the slide challenges with mutual fund. If you can throw some light on that one, it will be helpful because not everyone will go for ULIP.
One second. So challenges in case of mutual fund is I didn't present is because we. So this is is my slide visible?
Yes, sir.
Yeah, it is.
Yeah, it is visible.
See, the challenge with mutual fund is that we can do this rebalancing. In fact, there used to be a time we used to offer this. In fact, our earlier clients, we continue to serve them. We used to offer this with mutual funds only, but with mutual fund, the problem is twofold. Firstly, when you rebalance every month, most mutual funds in India have an exit load up in the first 365 days, in the first 1 year. So if you switch out of that fund from equity to debt, then most funds will charge you an exit load of 1%. Now, every month we can't afford to pay 1%, right? To a certain extent, we have been able to solve this problem for our customers who opt for mutual funds, who used to. Now we don't offer this with mutual funds because, to be honest, it has become very prohibitively expensive from a taxation standpoint. So what we do for our older clients to whom we had offered this using mutual funds is we use mutual funds which have an exit load up to 30 days maximum. So, and there are funds where there's no exit load beyond 30 days. So we use those funds to serve those clients. But then the problem is that you're limited to a very small set of funds which have an exit load within 30. There are not too many funds like that. Most of the high performing funds have an exit load in the first 1 year, but you can't use them. And the second problem of using mutual funds for this strategy is that, as I explained, the taxation is very high, right? We rebalance every month, and if you rebalance every month, then every month you are incurring short-term capital gains, and short-term capital gains have gone up quite significantly over the recent years. It currently stands at 20%, right? And in case of debt, there's no short-term capital gains. It's all taxed as per your slab. So these are the two challenges of doing the strategy using mutual funds, which is why we have practically stopped offering this using mutual funds.
Hi, Indraanil. I have one question. So firstly,
can you introduce yourself? Sorry.
Yeah. So this is Sumit, Bangalore.
Okay, Sumit.
Hi. So firstly, thanks for coming out for this with this beautiful idea. I really liked it. I can correlate it with NPS. In NPS also, we are able to switch 4 times in a year without the tax implication. And I was looking for how to do it with now mutual funds. So thanks for sharing this ULIP. The question is that when you will implement that switch, will we come to know? And the second question is, if we want to go ahead with the investment, what the process is for that?
So just go to our website metacaps.ai/products. You will see. So we offer the AlphaSIP strategy in 3 variants, depending on your ticket size. Up to 2.5 lakhs is AlphaSIP tax saver variant. 2.5 lakhs to 10 lakhs is what we call the AlphaSIP Pro variant, and more than 10 lakhs per year is what we call the Pro Max variant. So whichever variant you want to apply for, choose. Against that, you can click the button and there's a small form where you can just leave behind your phone number and name, and somebody will get back to you. Otherwise, in all my videos, you will see a WhatsApp number on the bottom left corner. You can just drop us a WhatsApp message on that WhatsApp number. The WhatsApp number, when I post the recording of this video, I'll mention that WhatsApp number in the description. But in all my videos, that number is there in the bottom left corner. So you can just drop us a WhatsApp. That's the quickest way, and somebody will get back to you.
Yeah, and my first question was when you will do the switch, implementing your 15 parameters or some other parameters, how we will know?
So when we see in case of HDFC intimates the customers. In case of Bajaj, lately we have seen that Bajaj does not send any email. So if you want to, so usually what we do is we rebalance on the first trading day. If you want to know that whether we have rebalanced or not, then on the day after first trading day, just log into your account and see if once we have rebalanced, even if the ULIP company does not send you an email, you will be able to see in how much fund is in equity, how much fund is in debt.
All right. And what are your charges for this strategy? How it works?
We don't charge anything separately. So we get a brokerage from the ULIP company. That's my only charge. And
all right.
Yeah.
Thank you.
Indraanil, I have one question, Vikas from Pune. So you said that investing in ULIP and that ULIP should have an underlier as the momentum 50 out of those 500 stocks, right? So is that correlation is well set with HDFC or Bajaj or what?
So HDFC and Bajaj now offer. First thing first, I didn't mention this. We offer so HDFC and Bajaj, both these companies now offer a fund which replicates the momentum index. So there is a fund called Bajaj Nifty 500 Momentum 50 Index, and there is a HDFC Life Nifty 500 Momentum 50 Index. So both these companies offer respective funds from their end, which replicates this Momentum 50 Index. So which is what I basically said. Now these funds were not available as recently as one year back. Both these companies have recently launched these funds. So now we have access to this momentum indices because the funds are available, which replicates this index.
Got it. And the other question was, after the rebalancing, see, I understand that you are using 14, 15 different parameters, and you won't be going 0 to 1, right? 0 to 100 won't be.
We actually go only 0 to 1.
Oh, okay? 100% equity or 100% debt?
It's either, yes. So earlier we used to see as our confidence in our as we have seen the strategy work. So earlier we used to see, if you are doing 25% equity or 50% equity, you are basically trying to hedge your risk, right? That what if I go wrong?
Right.
But finally, if you are absolutely confident about your outcome, if you are confident about that in the coming month the Nifty is going to go down, then why should you be at 25% equity? You should be at 0 equity. You should not have even 1 rupee in equity, right? So as our as we have observed the performance of the strategy and we have been able to gain more conviction in the outcome of the strategy, we have basically over a period of time gone from, so every month the rebalancing actually takes us from 0 to 1.
Got it. And one last thing. So are there no ETFs? Because the costing in ETFs is way less than even mutual funds or any ULIP.
So there are, but again, as I said, so these funds that the ULIP companies offer, they offer the cost is about 1% in case of ULIP companies. So your return will be the return numbers that I showed you earlier. Worst case return of 24% is after factoring the 1% charge that the ULIP company is charging. Okay. With the ETF, your returns would have been higher. I agree, but the switching would not have been tax-free.
Yeah, I understand. Yeah, got it. Yeah,
is there any limitation on the number of times you switch between equity and debt?
In case of Bajaj, unlimited number of switches allowed in a year.
And HDFC?
HDFC also unlimited number of charges. Okay, so I forgot to mention this. We offer it using HDFC and Bajaj. In case of HDFC, we don't rebalance for you. HDFC, and in case of Bajaj, we do the rebalancing for you. You will ask me why? Because the reason is, with Bajaj, we have been able to build an integration with them through which we can do this rebalancing for our clients through an automated tool. In case of HDFC, we are still in the process of building. They promised to build this, but it's been pending for more than 2 years. So in case of HDFC, if we have to rebalance, I have to log into the client's account after taking an OTP from you on your behalf and manually place a switch order. So obviously I can do it for 5 people. I can't do it for 500 people. So till we get the sort of automation that is there at our disposal in case of Bajaj, we offer HDFC, but we offer HDFC. So if your purpose is only to get that tax advantage of getting a tax-free maturity amount, then do HDFC. If you also want that upside that comes because of the rebalancing, then you have to opt for Bajaj.
So one question, is there any risk of the government regulation change regarding insurance, which might affect your rebalance? Because if you are investing, you're investing for long term. So in a couple years.
Possible. I'm not ruling out. I think the biggest risk is that the mutual fund industry has been lobbying very hard for the up to 2.5 lakhs, the maturity amount being tax free, this concession to be withdrawn, because the mutual fund industry believes that they are being discriminated against. So they are after the government to withdraw this concession for the ULIP industry. So that's the one which is most at risk. I don't think that rebalancing for the first 5 years being tax free, that in itself is at risk, because nobody is really even lobbying for that to be withdrawn. And honestly, it's if in a ULIP product, if the money is locked away for 5 years and you have no means to get the money out and take the money into your account, there is even a case for taxing any interim switch. So I don't think that there is a risk of the switches being taxed, but that 2.5 lakh maturity amount becoming taxable, that risk is there. Having said that, historically we have seen that whenever any tax related change has happened, government has not implemented the tax change retrospectively. So whatever, if you buy a policy today, that policy's tax free status will usually should survive in future as well, even if the tax in future the rules change in the next budget. So newer policies after the rule change might get affected, but anything that is bought now, I think is still safe.
Thank you, sir.
Rajendra, you've been raising your hands for a while.
Yeah. So my question, Indraanil, here is that first thing, I think there is a typo error in your, because you'll be talking about momentum fund or an equality fund. Is it a combination of the two?
So there are two momentum. So Nifty offers two momentum indices. There is something called Nifty 500 Momentum 50 Index, and there is something called Nifty 500 Multicap Momentum 50 Quality Index. To be honest, I also don't know what is the difference between the two.
So I think it is a part of the factor investing process.
Yes, it's part of the factor investing.
And this is it a passive fund or is it an active fund?
It's a passive fund. So it's an index. It's an index which
it will replicate what the index would be giving.
Index is correct.
Okay. Thank you.
Yeah. Anyone else?
Yeah, and then one last question. I just wanted to check.
Who's this? Sorry.
Yeah, this is again Vikas Pune.
Yeah.
So if we go by this ULIP route, so do we get this ULIPs in our demat account, regular demat account, or is the depository for it is somewhat different?
No, ULIPs are not in demat form. ULIPs are these ULIPs are the ownership of this ULIP is always with you. You can log into your Bajaj Allianz or HDFC Life account, and you will be able to see where the money in which fund the money is in. At no point you have to give any power of attorney to me or to me. The only thing that I'll ask for is that once a year I will ask for a consent through a OTP. So through this, the consent that you will give me is a consent for me to churn your portfolio as per my logic. So once you give me that consent, based on that consent, I'll be able to rebalance your portfolio. But other than that, the ownership of the portfolio at all times remains with you.
I understand that, but I mean, who is the depository? The reason I'm asking is, would I be able to pledge it and use the fund?
You can pledge it. You can borrow. So Bajaj Allianz itself has a loan against facility for these ULIPs. But if you pledge this, then the rebalance, because once you pledge it, once there's a lien on this, then Bajaj Allianz doesn't allow me to rebalance you'll have to choose which funds you want to keep your money, and after that you can pledge. But after that, I won't be able to rebalance.
Okay, understood. Thank you. And do you advise if somebody wants to invest in one go rather than in SIP mode?
Good question. Thank you. So we have go to our website called metacaps.ai/products. We have a lump sum offering also. So in case of lump sum, our minimum investment amount required is 25 lakhs, and we have a slightly more sophisticated, more advanced product where we use almost 30 parameters to rebalance, and we do rebalancing twice a month instead of monthly rebalancing. That product has a minimum requirement of 50 lakhs. So you can do a lump sum also. The lock-in period of 5 years continues to be there. But in case of lump sum, there is an added benefit in both the 25 lakh and the 50 lakh variant. You can opt for a monthly income from sixth year onwards. So how much usually if you start with a 50 lakh investment, at the end of we have a structured product where you can opt for a monthly payout of up to 50,000 rupees per month from sixth year, and this monthly payout amount goes up by with inflation by about 5 to 6% every year for the rest of your life. We have so that monthly payout is an optional feature, but we have a lump sum option also. You can go to our website, you'll find the details there.
Hi, Indraanil, this is Ramesh.
I'll answer everybody though, so you guys don't have to rush, huh? So sorry, Ramesh. Sorry.
Yeah. For people who have been in the earlier fund, the Nifty fund, so how will the switch to the momentum fund happen?
Anyone who is in Bajaj, we will upgrade them to AlphaSIP 2.0.
How about HDFC?
HDFC, we will, as I said, in HDFC, we have accepted only one round of new clients. If you are there in our first round of customers where we are doing manually, where we are rebalancing, we will upgrade you for that as well. Yeah.
Okay.
But for new clients in HDFC, we will not do rebalancing.
Got it. Okay.
Yeah.
Fantastic. I mean, in general, it's fantastic that you guys are constantly looking at improving the returns. So really appreciate and I want to commend you on that.
Thank you.
Yeah, hi, Indri. Thanks a lot for this session and the opportunity. I think it was a very learning experience for me as well.
Thank you.
And the question that I have...
Can you introduce yourself? Sorry.
Yeah, my name is Asim. I'm joining in Noida. So I have a question for you. Since you mentioned that you will be, you'll be paid through these brokerages from HDFC Bajaj Allianz. But my question here is that what is the motivation that you're getting in rebalancing these, the money that we are going to invest with you if you're not charging us, then how does that work?
So, in fact, I would dare say that doing it through ULIPs is what removes any kind of conflict of interest, because in case of mutual funds, think about usually the way it works is I get a brokerage of about 1% in case of equity funds. In debt funds, the brokerage can be as low as 0.1 to 0.2%. So I have a perverse interest to always keep your money in equity, because my margin is almost 10 times in case of equities, right? But in ULIP, I don't get paid based on in which fund the money is parked. I have a flat brokerage structure in case of ULIP. So there's no conflict of interest that way when I do the rebalancing. It's only motivated by my logic, and obviously if there's no conflict of interest, then it's in my interest to do the rebalancing in such a way that it produces the best possible outcome for you as a client. And at the end of 5 years, obviously, if I'm able to do a good job, then I can expect you to continue staying invested and even give me more references. I don't know if that answers the question.
Yeah, thanks. That answers the question. Yeah, thanks.
Okay. Another, ma'am, you've been trying to ask a question for a while.
Sorry.
What's your name, please?
Hi, I'm Satish. I'm calling from Nasik.
Yes, sir.
The second part of the presentation has been quite open, and there have been a lot of questions on that.
Sure.
I want to ask a question which I have written over there. on the first part of your presentation, you said the red line coming down and the blue line, that is Nifty, is going up.
You're talking about the move index or
move index? Yeah.
Okay.
So in your previous presentations and previous videos as well, I had written this same query, which was not answered till date. But how do you explain that the blue line, that is the Nifty, keeps going up all the time, even when the red line is or the move index is coming down? Precisely after 2020, if you look at your own graph.
Is this the graph that you're talking about?
No, the other one. I'm sorry.
This is the move index. You're talking about the move index or the junk bond spread?
The junk bond, please.
But both of them behave almost the same way. Both of them are. So I understand where you're coming from. This is the one.
Yeah.
This is the one.
Now, yeah. See, even say in the 20s, in the 16, just as things happened in 2008, when the index came down, there was a shoot up of the bond spread. If you look at the other aspect of the graph, it does not show that that thing in the same manner.
Which part of the graph you see it's not behaving in the same manner?
See, this thing has come down. Actually, this is again not the one that I'm looking at. If you show that one, yeah. Now this
is this the one?
Recession. No, there is another one. There is another one whereupon you have shown it simply the same manner. Whereupon
I think he's asking, Satish is looking for the liquidity one.
Liquidity.
Yeah.
This one.
Yeah. Now, in this Fed-induced liquidity, you can see the post-2008 graph, then the post-COVID graph. Now there is QT that is going on, but the red line is coming down.
No. So okay. Thank you. I am not saying in case of move index and junk bond spread, I said they are inversely correlated. Here I am not saying they are inversely or cyclically related. Here I am only saying if the red line goes up, the blue line will definitely go up. I am not saying if the red line goes down, automatically blue will also go down. There are usually if the red line is coming down, that is negative for liquidity. That is usually not a good thing for stocks. But having said that, after 2022, there were other factors which served as mitigating factor. There's a video related to something called the RRP. If you drop me a message, I'll on our Metacaps WhatsApp number, which you see on your screen bottom left, somebody from my team will send you the link of that video. There's something called RRP, which served as a mitigating factor for. So as Fed was cutting liquidity, this red line was coming down. There is something else called RRP from where money was flowing into equity markets and was mitigating the impact of negative liquidity created by this red line. And as a result, during this period, despite QT happening, overall net liquidity conditions continued to remain positive, and that's why stocks in general, barring few periods, did quite well even during QT. So I'm not, so the point I'm making is, if there is QE, there is no doubt that stocks will do well. If there is QT, without any other mitigating factors, stock will not do well. But if QT is done in tandem with other mitigating factors like RRP, then stocks can do well even in a QT.
Fair enough, fair enough. But in that case, say in a case where, say, apparently, as you said, in the second half, if, and this is a big if recession sets into the US, how will that affect the QT or QE the way they define them?
See, QE and QT are factors which can influence stocks during times when the economy is growing.
Yeah.
Recession, by definition, is a period when the economy is degrowing. There is negative GDP growth. If there is negative GDP growth, that means there is outright demand destruction in the economy. People are not buying things. So companies are finding it difficult to sell their goods and services. If people don't buy, if in a recession, if people lose their job, obviously they will cut down on their spending. People will not go to restaurants, people will not go to malls. The people in general, barring essentials, people will cut down on their spending. When you cut down on spending in a modern economy, your spending is somebody else's income. That's how in a recession, because of rising unemployment, there is lower consumer spending, and lower consumer spending in turn leads to very bad outcomes for sales of companies, and company sales goes down, company profits goes down. More, in fact, for smaller companies, they outrightly go into loss. And these are the companies, if profits fall or company, and if the loss is very huge, smaller companies will actually shut down outright. Bigger companies profits will fall, or bigger companies might go into outright loss. If there is if companies go in loss, or if the company outright goes into a bankruptcy, then it doesn't matter whether the Fed is printing money or not printing, the stock of that company will go down. So that's why all this QT, QE, they matter as long as the economy is growing. Once the economy goes into a recession, QE is not what can save the stock market. We will see a crash. What typically happens is, in order to provide support to companies after a recession has kicked in and company stocks have fallen, after that usually Fed restarts QE or accelerates the quantum of QE. That helps the economy come out of the recession faster. But a QE in itself will not be able to prevent a stock market crash that is induced by a recession.
Got it. Very nicely explained. But as another hypothetical follow-through question, if at all there happens to be a recession in the US, and they usually say this, what would be your perception of our stock market or the stock markets in around the world getting affected? And if at all, to what extent?
To a very large extent. I think the correlation between US and India has been very, very tight. In fact, historically, we have seen that if you go by the precedence of all the recent recessions that we have had, Indian markets have in fact corrected by way more than US indices. During COVID, S&P fell by 30%, we corrected by 40%. During 2008, S&P fell by 50%, we fell by 60%. So not only are we very strongly correlated with US, usually the outcome for emerging markets, including India, is usually worse than what it is in case of US. So if there is a recession in US, you can be rest assured that we'll see a pretty large crash and a crash which is worse than what is witnessed in US.
Many thanks. Many thanks. Appreciate it.
Okay. Anyone else specifically on AlphaSIP?
Yeah, Indraanil, this is Rajendra once again.
Sure.
So my question is, in case of factor-based in investing, whether it is quality-based, volatility-based, value-based, or low volatility, and there's one more, I think four factor-based investments. Yeah, this what you are suggesting is a combination of quality and uh, basically value.
So what we use, we don't use value. So we use two factor based indices. One is this one is this momentum index, and there is another index which is which is very similar to momentum. It's called the alpha. So there's something called Nifty Alpha 50 index. The the outcome of that is even better than the momentum strategy. So we use these two.
So this Bajaj Allianz fund is a combination of
no,
quality
it's not a combination. So for each factor, they have one fund.
So the investment that we would be doing, it goes into one fund, which is a combination of momentum and quality.
So what we do is, let's say in every month, my model tells me whether you should be 100% equity or zero equity. So in a zero equity month, obviously all the money is in a liquid fund or a bond fund. In a month where my model is telling me you should be 100% equity, what we do is we will split the money across. There are 4 funds of Bajaj Allianz that we use. We use their momentum fund, we use their alpha 50 fund, and then there is some money that we keep in their mid cap and small cap fund also. So usually it's about 40% in the alpha fund, about 30% in the momentum fund, and the remaining money is split between the mid cap and small cap fund of Bajaj.
Okay, and one more thing, what I understand is in most of the factor-based investment funds, which mutual fund companies run, the drawdowns are very high. So, have you accounted for that as well?
So the volatility during 5 years will be high, but try to think about it this way. See, the reason we choose these high beta funds like a momentum fund is because these funds outperform the Nifty during bull runs, and they also outperform the correction in these funds is usually much higher than Nifty during a downturn, right? Now, in my strategy, I anyway am going to get you out of the markets during a downturn. Hence, you will be exposed to the markets only during times of easy liquidity conditions when markets are doing well. And during such times, the fund which will do much better than the large cap index or Nifty will be these momentum kind of index which have a very high beta, right? So that's the idea. We need funds which outperform massively during bull runs, and we don't care about the drawdown during a correction, because hopefully if 70-80% of the time I am able to get you out of the markets during a downturn, then you are largely protected from the downside, whereas you still get to keep the upside.
And in case of an investment in this kind of fund, how long can we keep this SIP running basically?
Minimum is 5 years. Beyond that, more than 5 years, beyond 5 years, you can continue for as long as you want.
Okay, and the tax benefit that is being provided, it will continue as it is so long as we do not withdraw that money.
Yes, yes.
Okay, thank you very much.
And even on withdrawal, it is tax-free withdrawal after 5 years?
If the investment amount is within 2.5 lakhs per year, then the entire withdrawal is tax-free.
Okay.
If it is more than 2.5 lakh rupee per year, then the taxation is same as mutual funds. You pay long-term capital gains.
So even if we start an SWP from this fund, let's say after 10 years, the withdrawals from the SWP will also remain tax-free also, right?
Yes. If the original investment was within 2.5 lakh rupees.
Okay.
Hi, Indraanil. This is Praveen from Bangalore.
Yeah.
Sir, do you also manage the AlphaSIP strategy for the old Bajaj? Because I'm holding Bajaj Allianz ULIP fund, so it was almost 7 years old.
Okay.
So do you also manage these types of funds now?
So you are saying you have an existing policy which you want me to manage?
Yeah.
That's difficult, sir. And it's not as if that I don't want to take it up, but the way this works is I told you there is in case of Bajaj, there is an automated tool that they have created for us where we can, using that tool, we can rebalance your portfolio using that tool automatically. I don't have to manually switch from one fund to another for each client one by one. I can do the switching for all my clients in one go. But I can do switching of only those clients whose policy is linked to my broker code. So if your policy is not has not been sold through my broker code, then your policy will not show up in that tool, will not be available for me for rebalancing.
Okay.
So I get, I mean, I would have loved to offer that as a service. I get many requests, but in these cases, I think the only option is you'll have to wait for these. If it's a 7-year-old policy, then you can redeem it, right? You redeem and you can reinvest we have a lump sum investment option also where you can reinvest the entire amount in one go.
Okay. Okay. Thank you.
Any other question? Devendra ji had asked me a question on chat. If there's no other question, I'll just take that up and maybe call it a day. There were 3 questions from Devendra ji. Question number 1, you compare only 5 years. Why? As people who invest in mutual fund may stay invested for longer with SIP. Question number 2, what happens if we want to continue with AlphaSIP after 2 years? Let me answer the second one first. What happens if you want to continue with the AlphaSIP after 2 years? It's not 2 years. The reason I say 5 years is because in case of ULIP, you have to stay invested for a period of at least 5 years. You have to keep in. Yeah. So if you want to continue beyond 5 years, up to you, sir. No problem. You can continue. But you cannot discontinue your SIP before 5 years. The reason all my presentation is basis 5 years is because at 5 years is the minimum required for ULIP. After that, if you're not happy, you can withdraw the money. So at the end of 5 years, up to 5 years, you don't have a choice but to stick to the policy. So at the end of 5 years, that's why I give you a perspective of the performance for a 5-year period, because that gives you some idea about what is the outcome that you can expect at the end of 5 years. I'm not saying past performance will necessarily be repeated, but for whatever the historical performance is worth, those charts give you a sense of what you can expect at the end of 5 years. Yeah, we will continue to manage the money. There is a fees for managing the money after 5 years. If in case of lump sum, there is no fees even after 5 years. But in case of SIP corpus, we are taking up the mandate to manage your money for the first 5 years. Beyond 5 years, you can continue with your SIP, but there are 2 options there. Either you can reinvest the money in another. Either you can pay, there's a fee that we will charge you after 5 years, or we give you a second option where you can reinvest the money in a new policy, in which case there is no fees. So we'll figure out a way to where you can continue even beyond 5 years. But the short answer is you can continue beyond 5 years. Okay.
Hello.
Yeah.
Am I audible? This is Sardeshmukh from Pune.
Yeah.
Can I go ahead with my question?
I didn't catch your name, sorry.
Deshmukh from Pune.
Okay, sure.
Okay. Now I wanted to check if one wanted to do a lump sum, can one do a lump sum and do the 2.5 lakhs per year?
Yeah. But they will be two separate policies.
Right. So one can have multiple policies. And this 2.5, do you need to put it every for a period of 5 years, every year?
Yeah. Every year you will. So the way usually it works is you have to do the first year's investment. We usually insist that should be done in one go. And from second year, you can either continue with a yearly investment of 2.5 lakhs, or you can even move to a monthly SIP.
So the Indraanil, this is Nandu. So if you did the SIP, then would your holding period have to be 5 years from the last SIP? So it's not like you're contributing for 5 years. It'll be it's 5 years for each installment, right?
No. It's 5. So it's so you'd start today.
Yeah.
Every year from today. At the end of first year, you will do your second investment. At the end of second year, you will do your third. So you do all your 5 investments at the end of 4 years. And you wait 1 more year for 5 years to complete, and you can withdraw the entire amount. You don't have to wait for each investment to complete 5 years.
Okay, good.
Okay. And if one continues beyond the 5 years, it still still goes into the same the tax-free thing.
Yeah. So if the original investment amount in that policy was about this tax-free thing, one thing that you have to be cognizant of is your total investment in ULIP should not exceed 2.5 lakhs. So if you buy one policy of 2.5 lakh from me and another ULIP policy from somebody else, only one policy will be eligible for tax-free treatment.
Fair enough. But if I buy from you only 2.5 on this tax-free thing, and I buy another lump sum thing, that's fine. The 2.5 will still count as tax.
Yeah. And that even with the lump sum, the 2.5 one will be treated as long as you don't have any other ULIP SIP policy.
Okay, great. Then just one final question, if I may. So what is the kind of returns? I'm sorry, in between the presentation, I was not fully there. But so what are the kind of returns one has had in the past? I understand that past returns cannot be projected onto the future. So what kind of returns?
So I'll, again, with the caveat that it's not indicative of future returns. This is, and also the fact that I will be very, I'll stress on this, that we have not completed a 5-year cycle with any client. We have started offering ULIP only in 2023. So it's been only 2 years since we have been offering this. These results are back-tested results. So for whatever they are worth, this is what the results have been. Worst case return 24%. Best case has been 45%. So you can with these momentum, if I use these momentum funds on the equity side, your returns have historically been 24% on the worst case. This is before charges. You should deduct about 1 to 1.5% from this to pay for some of the charges which are deducted by the ULIP company. So, but from 24, even if you deduct, let's say 1.5%, you are still talking about 22 to 22.5% return. Worst case.
These are all CHER numbers, right?
These are all per annum. These are all per year. CHER.
So these are the back-tested numbers.
Yes.
Would it be possible for you to share what the last 2-year numbers have been? Actual? Feel free to say no.
See, we refrain from sharing these because then what happens is it's there's a reason we don't share this, because I'm giving you a guidance for 5 years. At the end of 5 years, this is what you can expect. During that 5 years, it can be, depending on market conditions, your outcome can be. I'm not saying that through the 5 years you are going to clock 24, right? And
Fair
But we
enough.
have
So
out,
have
we,
your
but
returns been
I can
more than
assure,
5 or
but
10% from these
but I can
average?
assure you we have massively outperformed the Nifty over the
That's
last
what
2
I mean.
years.
That's what I mean. Thank you.
Yeah.
Okay, great. So I think my husband and me are both quite interested in this, and we'll be in touch with your office tomorrow, perhaps.
Thank you. Thank you. Thank you.
Thanks, Indrani.
Thank you.
Indrani, one last question from me.
Yeah. Who's this, please?
Rajendra once again, yeah.
Yes, sir.
So Indranil, regarding this mortality charges, if in some of your last videos you mentioned that if we are more than 50 years old, one should not take it. The mortality we can nominate our kids
Yes.
as.
So thank you for asking that question. So
Yeah. So in that case, my question is, in that case, if something happens to us during this SIP period, what is, I mean, how the settlement happens?
So if so just for the benefit of everybody else, let me just repeat what the implications of what you asked for. So usually, I think what you are asking is related to this.
I think you can quote my example now, Indrani. Ramesh here.
Hi, Ramesh sir.
You can quote my example.
Correct. So Ramesh sir has been a client for a year now. He is retired. So in his policy, he made a substantial investment with us, and in his policies, he had two large investments in the two policies. He had two of his sons as who are in their early 20s. They were the insured person. So basically, you have the option to have anybody in your immediate family, a spouse or a child, can be the insured person. And the importance of that is that if you're, let's say, more than 45, in case of a 50-year-old person, as you can see here, the mortality charge impact is 2%. 2% means if the returns are 24%, the fund has given you a return of 24%. After mortality, your return will be 22%, right? So 2% goes towards mortality. So for people who are more than 45, we usually suggest that don't have yourself as the insured person, have a child as the insured person, because the mortality charges tend to be very high for people who are 45 plus. To answer your question, sir, in this case, if something happens to you then the insurance is not in your name. The insurance is in the name of your child or grandchild. In this case, you still have the obligation to continue the investment for next 5 years. Otherwise, you will not. Otherwise, the final benefit will not come to you. So that's one thing that you'll have to figure out, that if you are somebody who is a senior citizen, you're nominating somebody else as the insured person. And if the insured person is not you yourself, then during the 5-year policy, if something happens, the obligation is still on your family to make good on the investment commitment for the remaining 5 years. Maybe did that answer the question? Or I can also explain, if you're not able to continue with your investments for 5 years, then what happens? Is that something that you want to understand?
Yeah, please, if you can.
Yeah. So typically what happens is, if you don't invest, if you let's say at the end of 2 years, if you're not able to continue with your investments, then for the lock-in is for 5 years. For the remaining 3 years, the money will be switched into what is called a suspense account. In that suspense account, you will earn returns equivalent to a liquid fund, about 5 to 6%. And then, so let's say for the first 2 years, I have done the rebalancing for you. After 2 years, if you're not able to continue with your investments, then the policy will become inactive and the accumulated money will be switched into a suspense account. You will earn liquid fund kind of returns at the end of 5 years, whatever is the amount that it has grown to, that you will get at the end of 5 years. So the penalty that you incur is that once the money goes into a suspense account, I won't be able to rebalance what the first 2 years worth of investment that you have done. Even that money will not be accessible to me. So I won't be able to do the rebalancing. So this is the hit that you take if you're not able to complete 5 years.
Okay. Thank you very much.
Shruti Patil, how does the 2.5 lakh in 1 year versus 15 lakh lump sum work in terms of taxation? So technically, you will ask us choose between HDFC Life and Bajaj Allianz, and you will switch from equity to other safe investment as per your analysis. Technically, were you investing in ULIPs through you? Sorry, I'm not sure if I got that question. Let me answer that first. Shruti, are you still there? Can you ask me your question in? I can answer the first question. How does the 2.5 lakh in 1 year versus 15 lakh lump sum work in terms of taxation? I think I've addressed that question. The 2.5 lakh rupee policy, 2.5 lakh rupee per year policy will qualify for tax-free treatment. The 15 lakh rupee lump sum, if when you withdraw that money, it will be subject to tax, but you will pay long-term capital gains tax, the same rate as what you would pay in case of a 15 lakh rupee lump sum investment in a mutual fund. So tax treatment, if it exceeds 2.5 lakh rupees per year, the tax treatment is same as mutual fund, but you always pay long-term capital gains tax in case of ULIP, never short-term. Any other questions? Ronak had a question. I have already invested in ULIP through your AlphaSIP 1.0 strategy. Can I invest in AlphaSIP 2.0 under my wife's name? I hope it will be tax-free and you will invest in Bajaj Allianz. So you can invest in your wife's name, Ronak. In fact, your AlphaSIP 1.0, your first policy also automatically gets upgraded to AlphaSIP 2.0. All our earlier clients will get upgraded.
So when we say upgraded to 2.0, will that be like change from HDFC to Bajaj Allianz or?
No. I can't change that. But I'm now. Earlier we didn't have these momentum strategy funds. Now we have access to the momentum strategy. So the main difference between 1.0 and 2.0 is the underlying funds that we use for rebalancing. So earlier we were using HDFCs or Bajaj large cap, mid cap fund or small cap fund. Now we have these momentum strategy funds at our disposal.
Okay, got it. So now you will just onboard, let's say if I invest in AlphaSIP 2.0, then you will use Bajaj Alliance policy.
Yes.
Okay.
Yes.
Okay, cool. Thank you.
Is that it? Any other questions? Otherwise, I'll call it a day. I'm really surprised that even after 3 hours, we still have 20 people on the call. I'm flattered.
Thank you. Thanks a lot, Indraanil. I think you have done a great job.
Thank you. There is one question from Ankit Shah. I'm holding a Tata AIA Sampoorn Raksha ULIP more than 5 years. Shall I buy a new ULIP policy from you? Always, please do. Unfortunately, I can't manage a Tata AIA policy. We'll be very honored if you switch the money to us.
Sir, Saurav here. I don't have a question. I just want to thank you because I have been watching your video for last nearly 1.5 years and learned quite a lot. So thank you for that. So I don't invest in SIP right now, but if there is any possibility, that is very nice strategy that you have developed. If there is any possibility in future. Thank you, sir.
Thank you, Saurav. Thank you. Whenever you feel like, please be in touch with us. We'll be honored to manage your money. And very happy that you liked my content.
Indraanil, good job, man. Very well done. Very well done.
Thank you. Thank you, sir. Thank you. Thank you. Thank you.
Fantastic.
Thank you. I'll be posting a recording of this video, so you guys, everybody can refer to this. Thank you. Thank you. Thank you.
Thank you, sir.
Recording stopped.